From wealthy developers to early retirees who are part of the FIRE community, many have enabled their financial goals through investments in real estate. However, real estate also looks like a lot of work, from new roofs, bad tenants, or vacancy risk, which led me to ask if there was another way to participate in this sector. If you're interested in generating cash flow from real estate, but are like me and have no interest in being a landlord, then this episode is for you. So, subscribe to the channel and join me today as we review real estate investment trusts and why those may be appropriate for our portfolios right here in the red zone. A real estate investment trust, or REIT, is a company that owns, operates, or finances income generating real estate and sells shares to raise capital to do so. Some key features of REITs include they allow us to invest in real estate without becoming a landlord or property manager. They also provide diversification to our portfolios. Even if you are just a price appreciation investor because you believe you will always be able to sell investments at the right time to generate income, you may want to hold a small percentage of REITs as they have less of a correlation with technology growth stocks, which are overweight in even a more diversified index like the S&P 500. Third, they allow us to collect dividends as 90% of taxable income that REITs generate must be distributed. That 90% required income is why I'm interested in REITs. And for those who are new to the channel, in 2024, I entered the 5 to 10 year period prior to retirement known as the red zone for its increased impact and therefore risk to your retirement plan. I created this channel to share how I'm adjusting my investing approach during this critical time. One thing to note is that REITs are highly sensitive to interest rates. As rates decline, REITs as a category will generally increase in price, while rate hikes generally cause REITs to decline in value. Although many investors will choose to invest in REITs via individual stocks, I personally am not on that path, as for me, there's too much to keep up with, too many REIT types and variants to feel like I would want or even be willing to do the research required and also remained informed about an individual stock. And I feel that those are requirements in order to make a significant investment decision. This asset class supposedly is better for active managers than more popular passive investing strategies when it comes to funds. However, looking at some of the larger passively managed versus active management funds, I don't really see that case. So I'm interested for the community. If you know of some active funds that routinely beat passive funds like VNQ or XLRE over a long time period, leave a comment down below. Finally, one type of REIT that I'm not interested in investing in are mortgage REITs, as they seem to be dividend traps. Here's an ETF ticker symbol MORT or MORT. And as you can see, its price generally declines, and even its total return barely matches a passively managed index fund like VNQ over a long period of time. There are some funds that I am interested in and that I'll probably review in a little more detail in a later episode, similar to a comparison I did in this episode for the utility sector. Until then, first up, we have several closed end funds from Cohen and Steers, including RQI yielding 7.7%, RNP yielding 7.3%, RLTY yielding 8.6%, and RFI yielding 7.9%. We could probably do an entire episode just figuring out the difference between these to try to pick an investment, but in the meantime, it seems like the obvious difference is that RQI, RNP, and RLTY all use leverage, while RFI does not. RQI and RFI are really mirrors of one another as they seem to have the same mix of stocks, preferreds, and bonds, with their largest equity positions primarily in the communications and logistics real estate sectors, with both having about 80% US exposure. RNP and RLTY are very similar as well, with RNP having about half of its portfolio in equities, a quarter in bonds, another quarter in preferreds and convertibles, while RLTY has about 70% equity and therefore 15% in bonds, with 15% in preferreds and convertibles. Both of these also have similar exposure. The difference is RLTY has about 10% greater US exposure than RMP. When we take a look at total returns, RNP wins over all the time horizons except for the 5 year, where RQI wins and RFI is generally slightly behind those two in various time periods. Next up, we have IYRI from NEOS, which will pay out over 10.5% for a year if its dividend continues. Here we see a price return where IYRI is losing to an index REIT fund like VNQ. But when we look at total return, we see it ahead as well as its price still increasing in a relatively flat period of time for the sector. IYRI also recovered well from the tariff announcements in April, but it's a very new fund. It's less than a year old, so it's difficult to judge that if a prolonged downturn occurs, if it would still be able to bounce back as well as the broader real estate sector. For open ended funds, we have the Hoya Capital High Dividend Yield ETF, ticker symbol RIET, which invests mostly in healthcare and office REITs, which have been lagging REIT sectors recently. We see that in its performance, where although it's beating an index fund like VNQ from a total return standpoint in the last 3 years, it is losing big time in price appreciation. Part of that could also be due not only to the lagging real estate sectors it invests in, but it also holds numerous mortgage REITs, which are also likely driving its underperformance. From a purely preferred fund standpoint, we have PFFR currently yielding 7.6%, which is a passively managed preferred stock fund, which has done okay over a year compared to VNQ, but has underperformed when we stretch the time period out to 5 years. Finally, we have passively managed XLRE and Vanguard's real estate fund, which I've used in many of the comparisons to this point, VNQ. XLRE has both a lower expense ratio and has slightly outperformed VNQ over numerous time periods from both a price and total return standpoint. VNQ does pay a higher current yield of 3.8% compared to that of XLRE, which yields 3.3%. XLRE, however, does have a slightly higher 5 year dividend CAGR of 4.8% compared to VNQ's of 3.6%. In summary, here are some of the things that I liked about each one of these funds, whether it was their dividend yields, expense ratios, or dividend growth. In my portfolio, I've decided to allocate 8% of my overall investment portfolio to real estate, primarily for its diversification effect against my other holdings and for its dividend yield. So, do you prefer individual REITs like ticker symbols O, NNN, or ARE, active management, closed end funds, or even covered call funds to gain your real estate exposure? Leave a comment below to let the community know how you prefer to invest in the real estate sector and why. Until then, I'll see you next time right here in the red zone.